Hey guys, how's it going? For this video, I want to talk about market structure. And for those who already know what this is, you can skip through, but I'm pretty sure a lot of you don't. So I highly recommend sticking through this and watching it through to the end. I just want to lay the foundations and help you understand the basics first before we get into any of the entry concepts or any of the concepts in general. And it's simply because even even myself tend to forget that to get these precise entries on the lower time frames, you need to work your way down from the higher time frames. And by that, I mean this. So you have your swing structure on the higher time frame, and that's price making these large swing type moves in its trending direction. So for example, in this example, we have price trending to the upside, right? Within that structure, you tend to say the swing structure is like anything above the hourly, right? Anything below, you'll tend to find the intraday structure within the wave, and that's this is the wave that's shown in blue. Now, what you want to understand is a break of structure. So you see how price is moving upwards, right? Is breaking these structures to the upside continuously here, right? Continuously breaking structure to the upside. And whilst price is doing that, you don't want to be selling, and vice versa. If this was flipped upside down and price was breaking structure to the downside, you don't want to be buying. Okay. Now, an important thing to understand is that sometimes, although so you might just go onto the lower time frames and see, for example, this here. You see price break structure here to the downside. Price might reverse back up here, feel an inefficiency, and then you enter, right? You enter a short position thinking, oh, okay, cool, price is now ready to move downwards. But what you fail to understand or fail to see is that, yeah, you might have gone into somewhat of a profit, but macro direction, the larger picture is that price is still moving upwards. So you're literally trading against the trend, and that's literally not the way to do it. Uh, sorry, give me a second. Let's delete this. Understanding these breaks of structures is literally key. You'll tend to find that sometimes price might wick these lows here, but you won't have full body closes, and I'll show you examples of this later. Now, what you want to do is enter upon these retracements here. You want to enter here, right? You want to enter here, here, and here. And this is not only to maximize your risk to reward, because think of it this way: if your take profit is up here, right, and you had fear of missing out, you're like, oh no, I'm gonna miss the move, and you bought within this wave. Let's say you bought here, right, and your take profit was like, um, let's just say your take profit was, let's just say it was here at this high, right? You're failing to see that although you might have caught a nice move, long term price is going to return against you. You might have taken partials here, but long term price is going to return against you. So what you want to do is let price make its move, wait for the retracement, let price come back to you, and then you take your position. You want to take your position at these optimal points of entries, yeah? And for your reversals, you want to look for a shift in momentum, and I'm gonna make a video on this as well. But essentially, what this is if let me just, for example, I'm just gonna talk about inefficiencies for now. Yeah, let's say there's an inefficiency that lined up with this structure up here. Yeah, so price came up. This inefficiency will be your higher time frame point of interest. So this is your POI, right? Now, once price reaches your point of interest, you don't take the position at the point of interest. What you wait for is an intraday break of structure. So if price reaches your POI, for example, it came back down and it didn't break this level here, your trade is invalid. You need to wait for price to come down right? Break this level of structure, like we did here to the upside. You see how price came up, broke this previous level of structure here. You need to wait for price to break this level of structure here, and that's your confirmation. That's your validation that okay, cool, the move is valid. It's I have my confirmation. I'm ready to take the move. Now you wait for your entry. Let's just say you had a inefficiency, sorry, here. When price comes back into your, let me just click this on. When price trades back into your region, you take your position, because long term, this is what you'll tend to find. That price is now going to create new market structure to the downside. Let me just do this quick and show you what I mean. Oh, like so. Price will start trending back. This is going to be your swing structure, for example. Price is going to swing down, break this level of structure here, like so, and start creating new market structure to the downside, continuously breaking the lower lows. And here you got you got a low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. But then, because we had a break of this swing structure here, first of all, this is a major break of structure. That is what you're looking for. When you have this break of structure, that is the key you're looking for. This here, this is how you get your optimal points of entry, but you need your higher time frame point of interest first. Now I'm going to show you a key example of this just to help you with your understanding. Give me a second. Let me just keep this here actually and zoom out. Okay, so as I said, you start on the higher time frames, and here, let me just delete this. This is a this was a GBP JPY setup. This trade is actually one I took. So we had our higher time frame point of interest here. This was our inefficiency that we were waiting for. Price came up. This is our swing structure. You see this swing structure, up, down, up. We reached our higher time frame point of interest. Now, if you work down, you can see this swing structure a little bit better now. See this swing structure. These aren't small moves. This is, look, from here to here. That's 189 pips. So you work your way down, and this is what you tend to see. This is what I showed you guys. Yeah. Okay, look here. This is your intraday structure now. Let's get the blue. This. Oh, let me turn this on. This is your intraday structure here. Right here. Up. Right. Now from here, this is where we reached the higher time frame point of interest. So from here, we were expecting a reversal. And what did we get? A reversal. Price came back down, broke levels of structure, for example, here. We broke that level of structure. Let me just zoom in for you. We broke this level of structure here, right? Price came down, broke it. We had full body close. We didn't just wick it. So for example, you see here, price came down. Let me just zoom in. Price came down, it wicked the structure, but it didn't close below it. But here, we came down, and you have candle closes below. That's a break of structure. That's your confirmation, right? That okay, cool. My move is now valid. Let me look for sell positions, and look what you tend to find. Oh, yep. This is what you tend to find. Price will start making new structure to the downside. To the downside, low, low, high, low, sorry, low, low. That's how you use market structure. And so for example, in this case, right, for your entries, you just look for your, I mean, I'm not gonna really go into entries right now, but let me just show you an example of what not to do, right? Let's look here, for example, right? Let me just go into the replay. Let's go here, yeah? If you jump onto the chart and you don't go to any of the higher time frames, like a lot of people do, if you don't go to any of the higher time frames to identify your macro direction, and you just go into the 15-minute, you're like, okay, cool, let me just look for a quick setup, and you're like, okay, cool, this is what not to do. Come to the chart and be like, okay, cool, here, price been uptrending, right? You can see this, it's been uptrending, and you're like, okay, cool, I have a break of structure here, yeah, that's good. You might enter upon this candle here, like so, and you're like, okay, cool, this is ready for a sell, and you enter. Oh, let me just get rid of that. You enter, right? Come on. You enter. You go into somewhat of a profit, 70 pips, right? You're still holding, and what you'll tend to see is that price will gradually reverse against you. There you go. Say your stop loss was at break even, you would have got stopped out, and eventually you would just got stopped, even if your stop loss wasn't at break even. That is the importance of understanding the higher time frame, your macro direction, and the higher time frame swing structure. Because although this is downtrending, like I've mentioned before, even though price might be trending downwards here on the higher time frame, we're still creating structure to the upside. Let's look, price broke this level of structure here. We're still creating structure to the upside. So there is no reason for you to be selling until price reaches your higher time frame point of interest and you have your intraday break of structure. That's how you use market structure to your advantage, to understand where you are in relation to market structure and how you can put yourself in the best position when entering the markets. Besides that, I highly recommend going to the markets and backtesting this. Sorry, going to the charts and backtesting this for yourself. Besides that, on to the next.